Corporate Finance Excel Practice Problem. In this presentation, we're going to work a practice problem in Excel related to compensating balance loan with idle cash and effective interest. In other words, we're going to talk about a loan which has a compensating balance. There's going to be some idle cash that will affect the compensating balance loan, and then we'll take a look at the effective interest on the loan so we can compare it and contrast it with other types of loans. Get ready. It's time to take your chance with corporate finance. Here we are in Excel. We have our information on the left-hand side. We're going to put that into the blue area into the worksheet on the right-hand side. Notice that we do have two tabs down below. If you're working along with the worksheet given to you, you might have four tabs, two with the answer to it, two with the worksheets. If we do go over to the second tab for the worksheet, we have a similar layout but different numbers for it. Going on over to the first tab, we will work through both of these problems in this presentation. In the first tab then, basic scenario is going to be this. We're looking for a loan. We want the loan of the $350,000, and the bank is basically saying, well, because of some risk factors or whatnot, we're going to require a compensating balance. So a compensating balance is one thing that a bank could do, possibly to alter the terms of the loan, maybe to mitigate the risk on their side. So typically they would do things if they see risk, like increase the interest rate for one, or they might charge fees or something like that, or set up the loan structure in a different way. But here they're going to say that we're going to basically require you to have a compensating balance, which is basically part of the loan that you can't use. So you're going to be paying interest on it, but you can't really use it. So that's going to be what we do now. So if that happens, then we have a couple questions. One, well, if I need $350,000, how much do I need to borrow in order to get to that? Now we've addressed that in a prior presentation, so you can take a look at it. We're going to assume in this case we have the $350,000 loan that we're going to take out, and we're going to then deal with this compensating balance with relation to it. The other question we'll typically have is, well, I mean, what does that mean in terms of standard interest rates? If I'm trying to standardize this thing and compare it to like normal loans, which is I have a kind of a concept of, how can I do that? Well, we can calculate the effective interest rate on the money we actually get to use. So we'll take a look at that. And then we might have a question. The new thing here is we're going to say, well, what if I already have money like in my checking account that I always keep a minimum balance on so that I can pay the normal type of expenses? So I always have that cushion on my cash. Could that be used towards the ability to meet the compensating balance of the 20%? And if the bank says yes, and we're going to say yes in this case, then we could take that into consideration as well. So let's take a look at this. So we're going to say the company is going to borrow $350,000. And there's going to be an interest rate of 18%, but there's also a compensating balance of the 20%. So that means we're not going to actually get to use the $350,000. We're going to have some compensating balance that we're going to be needing for it. However, the company keeps a minimum bank balance that counts toward meeting the compensating balance of $15,000. So we have this minimum bank balance that can count towards it. So then we got to think, okay, well, if I take a loan out for the $350,000, how much of it do I basically get to use? And then what's basically the effective interest rate on it? So we could say, all right, this is going to be a one-year loan. So when we think about our calculations of interest, we've got P times R times T. P is a little bit confusing because we got this question of, well, how much are we going to use principal and the loan amount, which is kind of different when we have this compensating balance. But when we're considering the interest calculation, we're going to use the loan amount. So the loan amount, which is going to be the 350, even though we don't really get to kind of use all of it. So then the rate is going to be that 18%. So we'll pick up the rate at 18%. Let's percentify this. Home tab, number group, percentify, underline, home tab, font group, and underline. That's going to be our interest. Now again, we don't have to worry about the fraction of a year or the time factor here in our calculation because it's 1 year. So that would just simply be 1. So we're going to say, all right, there's the 350 times 18, it's going to cost us interest of $63,000. So now let's consider the compensating balance required from the loan. And we want to think about it net of the fact that they're going to allow us to count this $15,000. So normally the compensating balance would simply be the $350,000 times the 20%, which is their compensating balance requirement. But we get to hold on to that we get to use that $15,000 towards meeting this requirement. So we just have to do one more calculation. It's going to be basically the $350,000 times the 20% minus the 15. Let's just work at that in a little table here. So we're going to say the required compensating balance, I'm going to put a colon, is going to be the loan amount, so the total loan, the 350, times the compensating balance rate or percent, and that's going to say 20%. They're going to say we want 20% of that as the compensating balance. Let's percentify that. Home tab number group, percentify. Let's underline it. Home tab font group, underline. That's going to be the required compensating balance. So that would be the required compensating balance. Let's indent these three. Home tab alignment indent, and then I'll indent this one more time. Home tab alignment indent one more time. And then I'm going to say this is going to be equal to the 350,000 times the 20%. So they need a compensating balance of the 70,000. But we said, hey, you know, we always keep like 15,000 in our bank account to meet minimum requirements and whatnot. So they're going to allow us to use that to count towards the 70,000 compensating balance to lower the risk of the loan. So we're going to say that's great. You know, at least we got that going for us. So we get to take that out of this 70,000 amount, and I'm going to say, all right, then the home tab font group underline. So then the compensating balance required, basically net of that 15,000 minimum balance we have, is going to be the 70,000 minus the 15. So now the compensating balance required is going to be the 55,000. So now let's think about like the effective interest rate. So now let's think about the effective interest rate, because we're going to be borrowing, in essence, in other words, 350,000, but we don't get to use the 55,000 really, right? So that's going to be the difference. We got to just hold on to that, even though we're paying interest on it. So then the question is, well, what is then our effective interest rate on the amount of the loan we basically get to use? So we can calculate this. We're going to say, all right, well, we know what our interest rate is, so we know what the annual interest rate is, so we can do our standard kind of effective interest rate calculation. I'm going to use this one. So the rate equals interest divided by P times T. P is going to be the kind of confusing factor, because P here is going to be the amount of the loan that we basically get to use. So we're going to say, all right, the interest, the cost of the loan, I'm going to put that in the outer column, was the 63,000. 63,000 cost of the loan. And then I'm going to be picking up the bottom half of this calculation, which is going to be the principal times time. Time's just going to be 1 in this case. So I'm going to say the principal, and I'm going to say the principal, or let's say loan minus the compensating balance. All right, and that's going to, and that we could call that the principal, right? Which we can call the principal. So that's kind of a confusing term here. We're going to say, all right, well, the loan was this 350,000, but we have this 55,000 that's going to be kind of idle for us. So we've got the 295,000 amount here. And then if we had the percent of a year, so I'll just put this in real quick, it's going to be 1% of a year, colon, is going to be the days of the loan, which I'm going to say are 360. I'm going to make a nice even 12 times 30 because it's for one entire year, so 360, or you can use 365. We're doing 360. We're rounding 30-day months. And then the days in a year, loaned, the days in a year are also 360, 12 times 30. And that means that I'm going to underline this. That doesn't mean I'm going to underline it, but I'm going to underline it. So that means in the percent of the year is going to simply be 360 over 360, or 1. So that's going to be 1. So then I'm going to indent these, selecting these three: home tab, alignment, indent. Let's indent here, home tab, alignment, indent. Let's underline here, home tab, font group, underline. And I'll call this a subtotal, because this is going to be the bottom half, P times T, which is simply going to be the 295 we get to keep, times the 1, which of course will be just simply the 295. So we're going to say then home tab, font group, and underline. So then the effective interest rate is going to be the cost of the loan for the year here, the 63,000, in essence, divided by the amount of the loan that we get to basically use. And that's going to be, let's percentify this, home tab numbers, percentify, and then add a few decimals. So we've got the 21.36. And then we can use that to basically kind of do some comparisons that can help us to standardize this kind of funny loan to other types of loans if we had some other kind of options that might be going for us. Let's do it again. Another one, practice problem 2, same kind of scenario. We'll have different numbers here. We're going to say that the company is going to borrow the $40,000. So and the bank is saying, hey, look, there's some risk involved here. So we can, when there's risk involved, the bank might increase the interest rate. They might charge fees. They might change the terms in some way. Or, in this case, they're going to have the compensating balance. Compensating balance means some of the loan's going to be basically idle, so that it could be used then, or give some more security on the bank that you'll be able to pay the loan back. So then the question, of course, is, well, how much do you need to borrow? We looked at that in a prior presentation. We're going to say that we're going to have the $40,000 here of the loan, and we've already figured out basically how much we need to borrow if there is a compensating balance. And then the next question is, well, how can I compare that to normal terms? Like if I was comparing it to other loans, and we're going to use the effective interest rate in order to do that, what would be the actual interest we might need? So to pay here, what is the actual interest on it? And if I have money, and this is the new thing, in our bank account, is it possible that I count that towards the compensating balance requirement? And if the bank allows us to do that, then that could help us out. That could be useful there as well. So first, let's calculate the interest. It's going to be this calculation here, I times P times R. Interest equals principal or loan times R times T. Once again, the principal is going to be the full loan, even though there's this compensating balance. We're paying interest on the whole thing. T is just going to be 1 because this is going to be a loan for 1 year. So we're going to say loan is going to be the $40,000. And then we've got the rate. The interest rate is going to be equal to the 11%. Let's percentify this cell. Go into the home tab, number group, percentify, then underline, home tab, font group, and underline. This will then be the interest, which is going to be equal to the 40,000 times 11, or the 4,400. So we're paying interest on the whole 40,000, but we have this compensating balance. So now we need to figure out the compensating balance net of this minimum balance we keep in our bank account, which the bank is going to count towards as some more security that you'll pay back the loan, decreasing the amount of the compensating balance. So in other words, if I had a 40,000 loan compensating balance of 26%, then we would have to take the 40,000 times the 26% to figure it out the balance. But now we're going to do one more step, subtract out the 3,000 minimum balance that we keep in our checking account, because the bank's going to allow us, to do that, which is nice. We at least get that. So required compensating balance is going to be, I'm going to pick up the loan amount, which is going to be the 40,000. The 40,000, we're going to multiply that times the compensating balance rate, which is going to be equal to the 26%. Let's percentify this. We're going to go to the home tab, numbers group, percentify, and then that will give us then the compensation balance requirement for the loan. And this is before we consider the minimum balance we have in here. So we're going to multiply this out. This would be the 40,000 times the 26%. Let's go ahead and underline the 26, home tab, font group, and underline. Let's then highlight these three, or select them, and indent them. Home tab, alignment, indent. I'm going to indent this one more time. Home tab, alignment, indent. And so then we're going to consider the fact that, well, we already have a minimum balance in the bank, which the bank is going to say, okay, we'll count that towards the 10,400 compensating balance. We're like, all right, well, we'll get that. We're going to say 3,000, and that means that the compensating balance then after that minimum balance is going to be equal to the 10,400 minus the 3,000. Let's put an underline here, home tab, font group, and underline. So now that we have that, we're going to say, okay, well, now let me figure out what the effective interest rate is, so I can kind of compare this to other types of loans and get an idea of what this loan is basically costing me, comparing the cost of the loan, which is the interest of 4,400 on an annual basis, to the cost of the money that I get to basically use. So let's think about that. This is our effective interest rate calculation. We're going to use basically this calculation. R equals, which is the rate, effective interest equals interest divided by P times T, And then P is going to be kind of the tricky thing once again, because that is going to be the amount of the loan minus the compensating balance. And then T is just going to be 1 because it's a 1-year loan, but we'll calculate that out. So we're going to say, all right, the cost then, the interest, I'm going to put this in the outer column, is going to be the $4,000. That's what it's costing us to pick up the loan on the annual basis. And then we're going to say that the loan minus the compensating balance, which we can call the principal, but it's a little bit tricky, it's a little bit confusing. So we're going to say this is going to be, well, the loan was $40,000, and then we got to take out the compensating balance of the $7,400. That's going to be the $32,600, and then we'll take, so that's going to be the $32,600. I'm down here on P. Now I'll take T. I'm going to put that in a subcategory, even though it's going to end up being 1. So that's going to be the percent of a year, which would be the days of the loan, which is 360 or 365. It's going to be 12 times 30. I'm going to assume a nice even 30-day months. And then we got the days in year, which is also, of course, 12 times 30. If we make it nice and even, instead of 365, 360, we're going to say home tab, font group, and underline. This will then be the percent of year. And let's put an N here, percent of the year, which is, of course, going to be 360 over 360 or 1. So now we have P times T that we can take a look at. Let's go ahead and indent these. We're going to go to the Home tab, Alignment, Indent. I'll indent it again, Home tab, Alignment, Indent. And that'll give us then the effective interest rate on the loan. Effective interest rate on the loan. I'm sorry, that'll give us, let's have a subtotal here. Subtotal on the outside, which is going to be the 32,600 times 1, which is P times T. And then we'll have the effective interest rate on the loan. And so we're just going to be comparing then the cost of the loan, $4,400, the interest on it, divided by the subtotal here, which is basically the amount of the loan we get to use. Let's percentify this. Home tab, number group, percent. We're going to add some decimals so we get to the effective rate of the 13.5. Going to underline here, Home tab, font group, underline, that we can then use to compare to other loans. So once again, basic bottom line here is we're going to say, okay, we got a loan. We're looking for a loan. They're going to offer us a loan that has a compensating balance percent. The first thing we need to do is think about, okay, what's the loan amount we need in order to do what we need to do with the money? We're going to assume here we already did that. So we got the $40,000 that is the loan amount. And then we got to figure out, okay, what's the interest we're going to pay on that loan? So that's going to be the $40,000 times the rate of the loan. Then what's going to be the compensating balance so that I can figure out how much of the loan we're actually going to be able to basically use. And we're going to take that into consideration, the $3,000 that the bank is going to allow us, because this is in our checking account. So the bank says, hey, if you keep that $3,000 minimum balance, then we're going to count that towards this compensating balance. So that's going to be the $40,000 minus the $26,000 gives us the compensating balance of the $10,004 minus the $3,000. That gives us the $7,004. Then we can figure out the effective interest rate.